Over the last few years, equity investment has become very popular in India, be it individual stocks or equity mutual funds. The simple reason is because equity market has generated high return when compared to some other asset classes. But there's a catch. A lot of new investors may be getting greedy for high returns and may be completely ignoring the risk aspect of the equity market. They fail to understand that the stock market does not always go up. It can also generate negative returns over a period of time. On top of this, many investors are completely ignoring their risk appetite. That's where it's very important to understand the role of each asset class in India and how do you build a diversified portfolio as per your risk appetite and financial goal. Because every asset class may have its own utility because of different levels of risk tolerance. Hello everyone, I'm Sahil Bhadvia and today's topic covers the different investment options you can consider to create a diversified portfolio. So let's identify various investment options in India and figure out how to build a diversified portfolio. First option is fixed deposit and recurring deposit. FD, that is fixed deposit, and RD, that is recurring deposit, are traditionally one of the most popular investment options in India. The biggest reason is fixed return. The difference between FD and RD is FD is for lump sum investment and RD is where you invest money on a frequent basis like a monthly investment. Although the returns from FD and RD are on the lower side, maybe in the range of 6 to 8%. The biggest advantage is peace of mind because your returns are fixed. FD and RD are a great investment option if you have a short-term goal like buying a car in the next 1 to 2 years, paying your children's school fee next year, or building an emergency fund. FD is also a good investment option for a retired person who does not have a high risk taking appetite. Second option is PPF, that is Public Provident Fund. It offers one of the best return in the guaranteed return category, which is currently 7.1%. On top of this, PPF enjoys EEE status where interest earned is exempted from tax, principal is exempted from tax, and investors can save tax as well under 80C. The only disadvantage is there's a lock-in period of 15 years. This makes PPF unsuitable for short-term investment. Although some premature withdrawal is allowed only for emergency from 7th year. But it is only good for long-term investment goals like higher education for children or retirement planning. Then third option is NPS, that is National Pension Scheme. Technically, this scheme does not fall into fixed income category as the return on investment is not fixed. It would vary in the range of 8 to 12% based on the investment options you have selected. Moreover, NPS is very helpful if you want to save taxes under old tax slab. The drawback is that NPS has a lock-in till 60 years of age. Although in certain cases such as illness, educational expense of children, marriage of children, starting a business and so on, some of the money in NPS account can be withdrawn after a lock-in period of 3 years. So it is strictly useful for retirement planning. Another catch is that you only get 60% of money as lump sum on maturity. Remaining 40% is paid in the form of pension. However, 60% of the lump sum money is tax-free. Fourth option is gold. The biggest advantage with gold is high liquidity. You can sell it anytime in case of an emergency. Another benefit of gold is that it is an internationally accepted asset class. So if the Indian currency loses its value due to inflation, your gold investment would still remain intact. That is the reason it may be good to diversify your portfolio with 5 to 10% exposure in gold. On an average, you can expect a return of around 8% from gold investment for the long term. Now, historically, people have invested in physical gold. But today, you have multiple options to invest in gold that include digital gold, gold mutual fund, gold ETF, and sovereign gold bond. Fifth option is real estate. The biggest advantage of real estate is stability and tangibility. Real estate investment offers a unique combination of stability and tangibility that provides a sense of security. Unlike stocks or mutual funds that can be highly volatile and subject to market fluctuation, real estate offers a physical asset with intrinsic value. Although you need a substantial amount of money to invest in a real estate. For a high net worth individual, real estate may be a good investment for diversification. Sixth option is stock market. In stock market, you can buy or sell shares of public listed companies. Stock is an asset class that falls under higher risk and higher return category. While some companies can generate multi-bagger returns for the investors, some can even destroy wealth. Hence, it's very important to build the right knowledge before investing in stock market. Stock investment also requires a lot of research. So if you want to be a part of India's growth story, stock market can be a great investment option, but it requires a lot of time and knowledge. That's where you also have an option of equity mutual fund, where fund manager would invest your money in stock market with the required knowledge and skill set. Overall, as an investor, you should build a diversified portfolio as per your financial goal and risk appetite. If you are in 20s, 30s or 40s, for short-term goals with duration less than 2 to 3 years, it's better to allocate money in options like FD, RD, debt mutual funds. For medium to long-term, equity mutual fund and stocks may be a preferred option. PPF and NPS are also a good option to diversify for retirement planning. Sukanya Samriddhi is very good for parents who want to invest for girl child. If you are in your 50s or 60s and have less risk-taking appetite, it may be better to have higher allocation in fixed income instruments. Gold and real estate also provide a great diversification option to the portfolio. Well, that's all for today. I'll see you in our next video.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.